Hello and welcome to the brand new edition of The Big C, your one-stop destination to demystify all commodity, crypto and currency trades. I'm Manisha Gupta. On the show here in studios is Vishal Goenka. As I said, he's co-founder at IndiaBonds.com. Vishal, I thank you so much for joining in. And the reason to get you in the studio is because we have been getting so many questions as we've been talking more about bonds in the last few days here. And the cherry on the cake really has been about the Niti Aayog 137-page report. How have you read that? And this whole narrative about retailing or retailization of bond markets as in?
No, absolutely. I think, Manisha, thank you for having me on the show. Niti Aayog is really where the policy inception or a roadmap of capital markets policy starts. So I think for the first time, the focus on corporate bond market in 137-page report is a starting gun of really big bang reforms, which I think are due to come in the country. Very simply, equity and bonds both are important. We are an equity crazy country. We love equities. The awareness and education of bonds has to be spread. And that's what we see in volumes, right? I mean, number of trades in corporate bonds this year are set to double over last year.
Well, yes, 2024 and 2025 really build up on that. When you look at the last 1 month as well, Vishal, from 11.9 to 16.4 lakh trades is what we've seen in the last 1 month. Can it sustain?
Yeah, so that's
and
like
can it sustain and grow?
No, absolutely. That's like in the annual number. Now, the number of trades flat line for 5 years around 11 to 12%. So a lot of the non-believers saying fixed income is boring, we don't care about fixed income. Well, numbers don't lie, right? So for the first time, we see a complete breakout where number of trades are set to double. India is saying, listen, we are now a little richer country. We are $4.5 trillion. I'm going to diversify my portfolio. And I couldn't do it earlier. And thanks to technology, I can do that. So very, very constructive and optimistic on the growth trajectory ahead.
You know, Vishal, this is a question that you hear too often, is that bonds are slightly difficult, especially when it comes to selling them.
Yes.
So what would you want to tell all of these investors?
No, I think firstly, selling is as simple as buying. We need a certain market infrastructure development to happen. And we are actually in conversations with both the large market intermediaries, the depositories, whereby you should be able to click and sell a bond. Our infrastructure is actually made for equity, really. And I'm very happy the progress that we've made where clients should be allowed, because right now there's a little bit of a paperwork involved, and sometimes it delays, it takes 2 to 3 days. But I'm sure people who are watching this, and there is a lot of work happening, and buying and selling bonds will be as easy as equities.
Vishal, we were inviting some questions to ask you from the viewers as well. Yes. And the latest narrative really seems to be on the SEBI chief statement about bond derivatives. And then SGX as an exchange as well, talking about a possibility that there could be an Asia bond as of a market. How are you looking at these developments?
I think any derivative market to evolve, and I've traded in, across many countries, you need a much more liquid underlying asset class first.
And India?
And India is a developing underlying asset class in terms of bonds are concerned. So we do have futures and things like that on the government bond market, which is very, very liquid. I think derivatives in the corporate bond sector is little while away.
And there are various questions, but I want to come on to this one as well from if a company defaults, because what you're getting into with the company is a very long-term scenario. If there is an issue with the company going forward, and while, of course, all of us know that we have to look at the ratings therein, yes, but how are investors then informed and protected, and where do you look at all of that news, etc.?
I think education and awareness is the primary focus, which we have kind of, set on that path right now. Just to give you some stats, the U.S. market, which is a $44 trillion corporate bond market, has a 4% annual default rate. 4%. And in India, the latest CRISIL report says we have under 1% default rate.
But our market is?
So our market is obviously just $643 billion. So all I will say that there's a natural learning that any investment is not risk-free. In case of default, there are two things that happen in India. One is an amazing regulation called the Indian Bankruptcy Code, which came in 2016. So if it's a corporate, and defaults, companies get put into that for a quick and faster resolution. If it's an NBFC, then the jurisdiction lies with RBI to put in an NCLT or not. But as an investor, I'm always informed because debenture trustees, technological apps like IndiaBonds will inform you about results, about rating changes. Be sure to diversify your portfolio. Stay away from BBB minus and BBB, the riskiest segment of the corporate bonds. And I think we should be fine.
I have a question that just come in some minutes ago, Vishal, and it says, would you want to list out certain bonds that, as a beginner, one should get into?
So I don't want to name single names. We're a regulated entity, and I don't want to talk about it. But as a beginner, go for safety. Before understanding the asset class, buy a AAA public sector. What I can talk about. Power Finance Corporation announced its IPO yesterday, bond IPO at 7.3%. Go and apply for that. Apply for and invest in a AA plus security. Understand how fixed income are. Please do not go as a starter for 10 to 12 to 13% kind of returns and see how it all works.
And I'm going to take a name here because this is coming in from Srinivas, who wants to know on where do you get the latest updates, news when it comes to bonds?
Very interesting question. One is watch Bond Street on CNBC TV 88, hosted by Manisha.
Very nakedly pitching it here.
But no, I will tell you, it's a very, very interesting feature, because we are so set and used to equity markets, very interesting feature, for example, we've added on IndiaBonds is if you invest in a bond, we actually send you all the news of corporate updates, company quarterly reports and ratings updates. So there is not a wide, readily available information. I think we are getting there. But yeah, you can see it on television, you can see it on our app.
We do talk about perfect portfolios, but I'm assuming almost none of us have them really. When it comes to a portfolio, what would you say? What should be a percentage of debt or bonds in it?
So if I look at globally, people only talk about equity and fixed income, a 60-40 kind of an allocation. In India, we are learning about fixed income. I think an ideal portfolio should have about a 30% exposure to fixed income, a 40% to equity, and the remaining you can balance between real estate and alternatives. Within the fixed income portfolio of 30% in the overall portfolio, I think that should be further divided. You should have 20% in fixed deposits, 20% in long-term government bonds, because I'm very bullish on the 10 to 15-year government bonds, and I do see the curve flattening. 40% in high yield and 40% in like AA plus kind of thing. So 30% of your overall financial portfolio has to be in fixed income to survive volatility.
Vishal, this is a question that I'm also reading out, which says that equities haven't done so well in 2025. So when it comes to 2026, what are you suggesting that? What is the kind of mix that one should have? I know it's almost a duplicate kind of a question, but yes, this is a question that has started to come in. Equities haven't given you that kind of a return. Commodities have, and will debt do?
No, absolutely. I was just joking with someone. I'm not an equity expert. I said the returns of 23, 24 on equity, we should forget about it in the next 5 to 7 years. That was really India catching up to the global scenario. We did a very interesting study, Manisha, where equity returns in the last 4 years still date are around 42, 43%, and bond returns are 10% is the same. 26, what equities are down 2% already. So I'm not, I think most of the people I read are talking about 8 to 12% growth in equity this year. Hence, a 30% fixed income allocation lets you sleep more in peace without the volatility. But always to weather volatility and get regular income, 30%, I would advise. You can go as high as 40, 50%, depending on the life cycle, because a lot of senior people or retired people ask me, I have less risk appetite. What should I do? I said you can go as high as 60 to 70%.
One of the other reasons that not too much of money is parked in bonds, or maybe that is about to change, is about the lock-in period. Is it too long in the times of instant gratification?
Very good question, and this is actually one of the myths I would like to bust on this TV channel. There is no lock-in period in bonds. Your bonds can be in your demat account like your equity. If you buy bonds on a platform at 3 p.m., they're sitting in your demat at 6 p.m., and you can sell it in 2 days. There is no lock-in. You choose the maturity of the bond to suit your investment profile.
Talk to us also about the secured and unsecured bonds. That's yet another debate that continues, rages on.
Yeah, so very simply, what is security? If you give a loan to a friend and he says, okay, if I don't give you the loan back, take my motorbike, which means that is secured, right? Rather than relying on a friend. Secured bonds are where the company says that there is certain collateral, an asset. Asset could be a immovable asset like a plant, machinery, building. For NBFCs, they said there's a pool of receivables. I'm due to get this money in future, and that you have the first right on. So typically, if something were to go wrong with a company or default, then a secured asset or secured bond is much better because you can go after those assets to recover your money. Unsecured bonds are typically issued by very large companies, public sectors, AAA, saying, hey, my name is enough. I have a multi-billion balance sheet and it is okay. And you get paid more to take unsecured, but we always advise retail investors go for secured bonds only.
All right. Well, that's a cue coming in from Vishal. But as we wind down this conversation, Vishal, what is your wish list from budget? What is the industry looking at budget from this time?
So I will go back to your first question about the Niti Aayog report. You know, we are very hopeful for about 2-3 things to happen.
Okay.
One is there was this TDS introduced on listed corporate bonds in 2023. Since 2008 and 23, we had no TDS. This makes calculations very difficult because your IRRs get complicated. You have to fill forms, people who want a reduction. So we are very hopeful that this TDS on listed bonds gets rolled back, which will be a great shot in the arm. The second thing that we've spoken about is about tax equalization. So listed corporate bonds, our interest income is taxed as your slab rate. But if I look at equities, you know, short-term capital gains of 20 and long-term of 12.5%. If I look at debt mutual funds, 20%. So, you know, if you can get something like a capped tax rate of 20% for interest income, I think that will lead to a massive boom in this market for sure. And my third ask is we have a very steep government bond yield curve, right? So in spite of 125 basis cuts in repo rate, the 10-year bond is down by 20 basis. The 15-year bond is actually higher by 15 basis. For rates transmission and growth in the economy, you need a flatter yield curve. So that fiscal prudence, if shown by the the finance minister and the borrowing program of the government, might lead longer bond yields lower. So 3 wishes: take away TDS, cap the tax, and bring the bond yields lower.
Oh, well, all right. We hope that 2026 gives you all of those 3 wishes. And we have still some questions coming in. But this is CNBC's initiative talking to you about bonds and simplifying, demystifying that space. And we're hoping, Vishal, that very soon we will be able to cover the other questions as well, which we are looking at currently coming in as well. But thank you so much for joining in. Appreciate your time.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.